In this mission briefing, we note that semiconductors and hardware have taken a major hit, while software, healthcare, and financials are attracting capital. With the fastest sentiment shift since 2021 and record-breaking dark pool transactions, it is clear we are in a period of rotation. The situation can be summarized by three key figures: a 14% drop for SanDisk, a rapid decline in bullish sentiment to 31.4%, and the largest QQQ dark pool transaction on record. This is a two-factor market undergoing a significant rotation. This video will cover 8 detailed sections, ranging from the recent sentiment collapse and the metacompute narrative, to dark pool records, leverage liquidation, the two-factor market structure, sector rotation, hardware analysis, and broader systemic risk factors. Section 1 explores the snap. In just 1 week, bullish sentiment plummeted from 45% to 31.4%. Such a rapid break in sentiment often indicates that informed participants are making significant moves. The collapse in bullish sentiment was swift, with over a third of the bull camp evaporating in a single week. This is the most significant weekly drop in sentiment since 2021, marking a sudden change in market confidence. As bulls retreated, 42.3% of respondents turned bearish, with roughly 25% moving to a neutral stance. When the market crowd flips this hard and fast, it serves as a critical signal for the contrarian investor. This chart visualizes the sentiment flip. The 14-point drop in bullish sentiment is the largest one-week shift we have seen since 2021, highlighting the intensity of the current market adjustment. Sentiment velocity is more vital than the level itself. A sudden snap suggests the crowd was blindsided, which historically precedes a period of consolidation. We are currently observing a long-legged doji on the S&P 500, indicating significant indecision amidst increased dark pool activity. Market history reminds us that a loss of sentiment and trust can have long-lasting effects. Enron serves as a classic example of how a collapse in confidence can lead to a broad sell-off, a lesson we must keep in mind for every cycle. Key takeaways from Section 1: the fastest bull flush since 2021, high levels of market confusion, and the formation of a range in the S&P 500. Remember, sentiment reflects the mood, but flows represent the money. Section 2 focuses on the meta-tell. A single comment regarding excess compute capacity has created a crack in the narrative of AI scarcity that has dominated the hardware and semiconductor sector. While monetizing assets is usually standard business, the context here is critical. The entire semiconductor supercycle was built on the narrative of extreme scarcity. Meta suggesting it has excess capacity contradicts that foundational story, raising questions about current demand. We see two ways to read this headline. The bull view sees a new revenue stream and efficiency, while the bear view highlights the contradiction of infinite scarcity and the potential weakening of the marginal bid from major compute buyers. Ultimately, this is a tell, not necessarily the trade itself. The semiconductor sell-off preceded this news, suggesting that smart money was already positioning. Headlines often provide the story after the capital has already moved. In this next section, we look at why the scarcity math has changed. The hardware supercycle depends on a few massive buyers like Anthropic, OpenAI, and Meta. If one shifts their strategy, the price setter for GPUs and memory changes, leading to a repricing of the entire sector. This sequence isn't random. First, we saw semis post their worst month, followed by dark pool activity, the excess compute mention, and retail capitulation. These are consistent markers of distribution, narrative shift, and final exhaustion in the market cycle. The core question now facing the hardware trade is simple. If one of the three major compute buyers stops aggressively purchasing, what happens to the pricing power of the entire industry? To summarize, the quote, excess compute narrative contradicts the scarcity thesis. The sell-off led the story, proving that flows often dictate the narrative. This doesn't signal the end of AI, but it does challenge the assumption of infinite, price-insensitive demand. Section 3 moves to dark pool records. The largest QQQ transaction in history recently printed. This volume confirms that a significant handoff is occurring, which is characteristic of institutional, not retail, positioning. History was made in the Qs. We saw the largest dark pool transaction ever recorded, and the fourth largest within the same week. Institutional blocks of this magnitude are deliberate moves, not accidental occurrences. Tape structure shows a war zone of positioning between the top and bottom of the current range. With record volume prints landing inside this zone, we are witnessing a critical transition period that will determine the trend direction. The record-setting activity extends across the complex. Beyond the Qs, Micron and GLD also saw massive all-time high transactions. When key stocks show this level of volume after a major move, it is a signal to pay close attention. Micron's record prints happened after the significant move, which suggests institutional repositioning. Whether they are cashing out winners or rebalancing size, the message is clear. The largest players are changing their stance on the hardware trade. At Hollowpoint Trading, we view dark pool prints as footprints, not signals. Context is what resolves direction. Are we at support or resistance? By combining these prints with options walls, we can frame the institutional activity effectively. The Qs remain the focus. Seeing the largest and fourth largest transactions ever in a single week is arguably the most important flow fact of this entire briefing. Section 3 takeaways. Record prints across QQQ, Micron, and GLD indicate a significant repositioning. As we enter the next market session, we are watching for confirmation that rallies are being sold into, which would finalize the distribution thesis. Section 4 addresses the leverage carnage. Retail investors flock to leveraged ETFs at the peak of the rally. Recent market volatility has now collected the bill on those positions. The 3 times leveraged semiconductor fund saw a decline of nearly 43% from its highs. This demonstrates the harsh reality of using leverage. The downside arrives much faster than the growth phase. The liquidation cascade works by triggering margin calls when the underlying assets drop, forcing mechanical selling. This waterfall effect often moves independently of underlying fundamentals and is purely driven by market structure and leverage. We are now looking at the damage report. A 20% drawdown in a leadership group is historically where a dip stops and a regime question begins. Semiconductors have crossed this threshold, while leveraged funds have seen massive declines, hitting levels we haven't seen since early May. Why is this 20% mark our line in the sand? While 10% pullbacks are often just noise, a 20% drop in leadership forces every systematic fund and risk model to reassess. It breaks the psychology of dip buyers, turning them into rally sellers. This chart shows how pressure levels are stacking. We have arrived at the first level of potential pressure. Bears are watching for a failure here, as a breakdown could trigger a systemic-style sell-through across the leveraged complex. The risks are real. We are back to early May pricing, and those who bought the top are facing significant losses. It is a dangerous time to be overly leveraged, as the market is clearly repricing the entire sector. For Section 4 takeaways, remember that leverage converts a simple correction into an emergency. Mechanical selling from these products fuels waterfall days, and if you must use them, always position size like you could be wrong. Section 5 discusses the two-factor market. The truth is simple. If you strip away semiconductors and hardware, the rest of the market hasn't been bad at all. That is the entire story in one sentence. We track the MAG7 against the rest of the market. While semis are being violently repriced, other areas, like cybersecurity and broader tech, are absorbing the capital. This is a classic two-factor market rotation. We recently saw a weird flat session on the S&P 500. Intraday, the market was volatile, but the close remained unchanged. That gap between intraday intensity and daily calm suggests we are trapped in a range with zero resolution. This candle tells a story about human psychology. Up huge created greed, down huge created fear, and the flat close left traders confused. When a session feels this emotional, it is always best to zoom out before making any decisions. The Nasdaq is holding its sideways range. Support levels haven't broken, because the strength of the MAG7 and non-hardware sectors is offsetting the semiconductor pressure. We are watching the range highs and lows closely. Looking at breadth, the advanced decline line is printing higher highs and lows, which is a healthy sign. While one sector is falling, the generals are standing, and breadth is expanding. This looks more like rotation than a bear market. There are several different markets within these markets. That is the essence of our two-factor thesis, and it's essential for navigating this volatility. Section 5 takeaways. The index hides sector-specific crashes. Remember, bad breadth with a rising index is dangerous, but good breadth with a falling sector is just rotation. Size down and watch the range. Section 6 covers the rotation map. Money never leaves the market. It only changes seats. We are seeing a distinct movement as capital flows into value and cyclical names, away from the tech darlings. This rotation rhymes with late 2020. As leadership gets sold, cyclicals and left-behind sectors catch a bid. This is not just a sell-off. It is a healthy rotation, which historically provides the best environment for stock pickers.
Looking at market winners, healthcare and biotech are showing strong upside. Software is acting as an anti-semiconductor trade, while cybersecurity, financials, and emerging markets are also seeing positive movement. On the other hand, money is leaving several areas. Semiconductors have seen significant pullbacks, along with hardware and storage, levered semi-products, regional banks, and oil. It's a reminder that even within sectors, performance varies. Software is behaving as an anti-semiconductor trade, often catching a bid when semi-stocks decline. The IGV to semis performance ratio recently hit a key level on the cross-analysis, which historically signals potential mean reversions. Healthcare and biotech are key rotation destinations. They benefit from deregulation themes, minimal correlation to the hardware trade, and years of underperformance, which may attract institutional interest. This chart illustrates the IGV to semis ratio hitting its 50-day exponential moving average cross. As semis lose their 20-day momentum, this level serves as a critical point where relative trends have historically shifted. Here is a quick reference for rotation destinations: IGV for software, XLV and XBI for healthcare and biotech, and a combination of emerging markets and gold miners for global interest. To wrap up this section, this is a classic rotation playbook. Market leadership is shifting, and the IGV to semis ratio remains the defining chart for this trade. Stay focused on new opportunities as they arise. Now we examine the hardware sector. The backbone of the current market has shown its first significant sign of weakness, and we are analyzing the recent data to understand the shift. The massive hardware trade has broken below its 20-day exponential moving average, which served as a recent line of defense. We are now at a critical level regarding the 50-day moving average. We are seeing casualties across the sector. SanDisk, Micron, Tesla, and key semiconductor proxies have all shown weakness. When leaders fail together, it indicates a broader group event rather than isolated stock performance. The Palantir pattern offers a lesson in volatility clusters. The first explosion in an uptrend is a warning, but the second often marks a top. Semis have recently printed a similar, violent cluster. A drawdown of over 20% in a market's leadership group is a major warning sign. While this does not guarantee a bear market, it raises the possibility, and markets respond to these questions with increased volatility. The bull case for hardware relies on reclaiming support levels and strong future demand. Conversely, bears are looking for a failure to hold those levels, which could confirm a distribution phase. The fundamental question for current rallies is whether they are genuine or simply setting up for further selling. Monitoring dark pool activity helps determine if this is a temporary dip or a more significant top. In conclusion, the 20-day averages are broken, leaving the 50-day cross as the final structural defense. Respect the volatility patterns, watch the post-holiday tape, and keep a close eye on upcoming earnings reports. Moving to gold and metals. While the press may have written off gold's potential, the tape suggests a different story, as the market prepares for potential shifts in the sector. Headlines have been filled with negative sentiment about gold, including discussions of death crosses and poor quarterly performance. However, significant transaction volume in GLD indicates that institutional interest remains. Gold has pulled back into a key support and demand zone between 3,600 and 3,650. We are currently watching for a potential weekly tweezer pattern as a sign of stabilization at these levels. The metals dashboard highlights this recovery. With significant transaction volume, a move toward higher highs, and miners demonstrating relative strength, the complex is showing signs of stabilization. The fact that miners are refusing to confirm weakness in the spot gold price is a reliable indicator of an early turn signal. We are looking to the 20-day moving average as a confirmation trigger for this move. There is a notable link between Bitcoin and gold. Both assets are currently sinking, likely trading the same macro variables, such as liquidity and the direction of the dollar. Maintaining indifference and relying on price action, data, and flows is essential to removing bias. Arguing with the chart is rarely a profitable strategy when trading at critical support levels. To summarize, a combination of negative press, record prints, and a potential tweezer at demand creates a contrarian checklist. Watch the 3,600 to 3,650 support zone as the primary indicator for this trade. Shifting to Bitcoin, we see a conflict between two smart money indicators, whale accumulation on one hand and bleeding ETF flows on the other. On the bullish side, we see whale accumulation at the base and a recovery off the support zone. Conversely, the bearish case is supported by weak ETF flows and continued negative sentiment. Bitcoin is at a major decision point, with bearish sellers historically active at current levels. Whether the market has done enough to support a real recovery remains the key question. Whale wallets tell us about long-horizon buyers, while ETF flows highlight price-sensitive participants. Our rule is simple. Flows lead the weekly trend, while whales lead the quarterly trend. When monitoring Bitcoin, remember that price, data, and flows currently disagree. In such environments, reducing position size and tightening trading rules is the prudent approach. Looking at levels in gamma, the options market has established clear battlefields. We are monitoring walls and trapdoors as we navigate the current range. SPX levels are showing clear call and put walls. With the range trapped for the upcoming holiday period, Identifying the largest trade zones inside these ranges is critical for short-term positioning. Looking at the danger doors, we have clear levels to watch. QQQ, at 700, marks a negative gamma event, while semis are reclaiming the 600 put wall. These are the critical zones for market movement. Understanding negative gamma is straightforward. Above the put walls, dealers suppress volatility by selling rallies and buying dips. Below these walls, they flip to short gamma, selling into declines and amplifying the downside. The semiconductor 600 put wall is our focal point. After falling through it, a rally back toward the wall has occurred. The real test comes at full liquidity. Hold above, and it's squeeze fuel. Reject, and it's a ceiling. Here is our week ahead map. Respect the SPX 74007600 range. Watch QQQ at the 700 negative gamma door, and monitor semis above or below 600. Additionally, keep an eye on the 2-year yield's quiet trend. We are now moving into seasonality and systemic risk. While the calendar points toward early July strength, it also reminds us that the most volatile months of the year are fast approaching. There is a notable 25-0 historical record for early July bullishness following a negative late June setup. So far, the market is respecting this, rebounding despite sector-specific selling. Midterm year seasonality shows a pattern of early July strength, followed by potential consolidation, and then high volatility leading into elections. August through October are historically the most volatile months. Regarding systemic risk, we monitor the private equity debt load. A potential AI bubble unwind could slam the IPO window shut, causing liquidity issues for funds reliant on exits to manage their debt. The Enron lesson is a reminder that sentiment matters. When trust evaporates, the market sells off across the board, even if the structural plumbing remains intact. We watch sentiment surveys as key risk gauges. Our risk calendar is set. July 1st to 14 is a historically bullish window. August through October is the spike zone for volatility. Finally, earnings season will be a referendum on the market's trajectory. Now, for the playbook. The guiding principle is toe by the V rather than the dip. Focus on structure, follow defined entries, and leave personal opinions aside. On our do list, trade rotations into healthcare, biotech, and software. Honor the key levels at 700 and 600, and wait for full liquidity confirmation after the holiday. On our don't list, avoid buying dips in downtrends without structure. Be wary of levered products unless you accept their risks, and zoom out to avoid trading short-term emotional noise. Looking ahead, focus on Monday's liquidity, the IGV to semis ratio, gold's weekly close, and Bitcoin ETF flows. Watch the 2-year yield and the dollar as the quiet macro drivers behind these assets. As we conclude, remember, dull entries miss the mark. Stay disciplined with your price action, data, and flows. We look forward to analyzing the next move together.